When putting together any investment portfolio, it's really important to understand the level of risk that you're willing to take. The reason for that is obviously the more risk that you're taking, the greater the volatility is likely to be. But the generally perceived wisdom is that the higher amount of risk you're taking, over the long term, the better returns you'll get. It's really important then to understand that you're going to be comfortable with the level of risk you're taking, because in times when the market goes down, people can often be very concerned, but actually over the long term, what's more important to them, that potential fluctuations versus the potential better returns. However, there are other types of risk as well. Even money in the bank is susceptible to risk. There's default risk of the bank actually going bust. There's also the risk of inflation eroding the true purchasing power of that money, which is another vital point to consider. Here in Courtiers, we assess the level of risk that clients are willing to take through a number of methods. One of them is through the completion of a risk questionnaire, which is a series of psychometric type questions to gain a fuller understanding of people's level of risk. For me though, what's more important is really understanding each individual's circumstances, how they feel about risk in terms of, and also factors such as their age, their health. All these things come into account as well, so it's really important to talk through those as well. If you've got any further queries or questions about risks, do contact a Courtiers Adviser. We really appreciate your comments, so please do leave any comments below, and do come and check us out on Twitter at Courtiers Wealth and on Facebook at Courtiers Investment Services.